Has anyone ever told you, never invest in a company that you do not understand? Many folks have said this, the most famous of which perhaps being Warren Buffett. But what difference does it make? Won't you receive the exact same rate of return as someone else as long as you buy the same company and at the same price? By the end of this video, you'll know why understanding your investment is even more important than you might think.
We will never buy anything we don't think we understand.
Spoiler alert, it's true. Mathematically speaking, you will get the same return as someone else as long as you buy in at the same price. So, done? Video over? Well, it's not that simple. Let's jump into it. Investing is a massively psychological game. For those of you who are invested in March of 2020, you know exactly what I'm talking about. It's easy to sit here and theorize how rate of return is the same whether or not you understand what you own. It's another thing entirely when a collection of stocks that you own are dropping like a rock. It gets worse because a lot of these companies you don't understand or even want to own. You just bought them because you wanted to ride price momentum up for a quick buck. Things are still dropping. Some positions you own are down 30, 40, or even over 50%. What are you going to do? Are you going to sell? If you're pretty confident that you're not going to sell, I wouldn't be so sure. A lot of people say that, but they want to sell to buy back in at a lower price. It's usually a rationalization to not have the cojones to stick it out. Check out this graph from March of 2020. Many people sold during the crash. How many of these people were able to fully reinvest at lower prices? Probably very few. Nobody knew when the bottom would occur, and nobody knew we'd have a recovery that was essentially a straight line up and to the right that far exceeded previous highs. People babbled on and on about whether we'd have a V-shaped recovery, a W, a K, a U, blah, blah, blah. We almost ran out of letters in the alphabet. Nobody knew. But one thing that was true was that people who knew what they owned and continued to hold came out ahead. The thing is, when the stock market is going up, you can get away with not knowing what you own. Life is good. But when stocks start to fall and you don't know what you own, the data says that you're going to panic sell. But even more importantly, if you started buying a stock at 50 and now it's 40, you should be buying more aggressively. If you don't know what you own, I promise you, at 40, you are not going to feel like buying more. Humans' innate psychological tendencies hold us back as investors. Investing psychology should be talked about more here on YouTube in my personal opinion. Most people adjust their investment decisions to what their personal psychology says. Here at Phil Thompson Investing, we don't do that. We adjust our decisions and our psychology to what the math and probabilities say. Over time, we're able to reprogram ourselves so that our impulses more closely match what the right thing to do would be. It hasn't always been this way though. I've made plenty of my own mistakes. Let's check out this graph of Yeti. Pretty hard to have lost money, right? Well, I didn't understand the company very well when I initially bought in, and I didn't have any confidence in my investment. I managed to sell at a small loss. Fortunately, this mistake, as well as the others I've made, have been relatively small. I consider myself lucky to have made a few small goofs like I did here with Yeti. Now I won't be having to go to the school of hard knocks when there's more money on the line. One thing to keep in mind is that learning usually comes through experience, but it doesn't always have to be your experience. One idea that I mentioned earlier that's so important, I need to talk about it in a little bit more detail, is buying into stock price weakness. As a company's stock price goes down in the short term, we need to be ready and able to purchase up additional shares at these reduced prices. This helps us generate outsized returns over the long term. I promise you, when this happens, people are going to be freaking out and there's going to be a ton of negativity surrounding this stock. We need to just tune out this noise and buy additional shares at these lower prices. Let's say XYZ stock is trading for $40 a share. We decide to buy 100 shares for a total of $4,000. In the short term, the stock price drops to $30. We hold through this and eventually sell at $60 a share for a total of a $2,000 gain. Now, same situation to start. We buy 100 shares at $40 a share for a total buy order of $4,000. The stock drops to $30 a share and we buy $3,000 worth of additional stock, so another 100 shares. We then continue to hold all 200 of these shares and sell at the same $60 price. We now generate a $5,000 gain. Yes, we have higher returns because we put more money in overall, but look at that second tranche purchased. That $3,000 we invested doubled to $6,000. Buying into a company whose stock price has recently fallen is easier said than done. There's going to be a lot of negativity surrounding this. The stock price is falling after all. So you need to be ready both mentally and with your money to take advantage of these opportunities when they arise. And this isn't some fringe example. This is what we should be ready to do. Buying companies that have been beaten down unnecessarily, this isn't some rare thing. This is what we should capitalize on as investors. And the only way we're going to be able to do that is if we understand the company and its fundamentals. There are many other issues that come from not understanding what you own. For example, if a stock price doubles in 2 years, is the company now overvalued and it's time to sell? Or is the company just at the beginning and there are years of growth ahead? Additionally, is the company well capitalized? Is the balance sheet strong enough to endure a financial hardship, or is the company a bankruptcy risk? There's no way to have good answers to these questions if you do not understand what you own. With all of that said, you now know why investing in companies that you do not understand sets you up for investing failure. So instead, do your research, study up on the companies and their industries, make your buying decisions from a position of strength. Let's conclude by taking a quick look at how I managed to invest in 2020. Up until a year ago, I'd never really been tested as an investor. We had that one correction at the end of 2018, but there was really nothing more than that. That all changed in March of 2020. On March 31st of 2020, I purchased this townhome, so my cash reserves were largely depleted. But the money that I did have, I decided to put into stocks. As it turned out, I was a little bit too early on my entry, but it's always impossible to perfectly time the bottom. The key thing is that I never cashed out. I was comfortable with and knew what I owned. I held the line and continued to buy and buy and buy all the way through. I'm still buying, and I will continue to be a buyer of stocks. Sometimes stocks are on sale across the board, and sometimes valuations are flying high. But there are almost always companies out there with attractive valuations. Universally good advice is that when companies are attractively priced, we should be buyers of stocks. To summarize the video, understand what you own, buy more when the stock price goes down, and if you don't do those two things, there's a good chance that Mr. Market is going to teach you the lesson the hard way. Let's conclude the video today with a portfolio review. Given the topic of today's video, I'd like to point out that my top 3 holdings are the companies that I am most confident in. I've done lots of research on all 3 companies and am content holding the shares that I own, regardless of what happens to the share price in the short term. That being said, I want to jump into the next section here, which is on Micron Technology. It's a company that I've added to my portfolio relatively recently. I have 50 shares now. I've added 20 shares this week and would like to build this position to at least 100 shares, maybe a little bit more if I become more comfortable with this one. My cost basis now is $78.18 per share, and would like to continue adding as long as the stock price is below $80. Now, let's look at some basic fundamental analysis. I'm over on Fidelity's website, and I am comparing Micron Technology to Intel, NVIDIA, Texas Instruments, and Skyworks Solutions, all of which are semiconductor companies. This first page here is cash and debt, which is taken from the balance sheets of these companies. The most important thing I'd like to direct your eyes to right away is the current ratio. Micron's got a current ratio of 3.2, which is very strong. Anything over 1 is decent, anything over 1.5 is pretty solid, and anything over 2 is quite strong. This is a metric that shows us how strong the company's financial position is in the short term and its ability to meet its short-term obligations over the next year. And really all these companies are sitting good. I would not avoid investing in any of these companies just based on their balance sheet. Next up, we've got the growth page. A lot of these numbers have been messed up just based on some of the weirdness that has been going on with earnings out of the 2020 year. So not really going to spend too much time here. You'd have to dig a little bit deeper to get valuable information out of it. But suffice it to say, Micron Technology's earnings and revenue growth is very strong moving forward. It's not a hyper growth company by any means, but its growth numbers are very strong. That, taken in context with its valuation, is what makes this company so compelling, in my opinion. As you can see, the trailing 12-month PE ratio is 28.1, so not a super great price to be paying for this company, but not not too bad given its growth. And we see that growth reflected in the PE for next year. It's estimated to be a 7.3, which is incredibly low. It means we're paying a very cheap price for this company on a price to earnings basis. And that really, it's even lower than a low growth company here in Intel. Intel's at 12.2, so very strong coming out of Micron, and that growth just hasn't really been priced into the stock yet. If you look at the stock chart, we've seen it's been downtrending over the last couple months, and ultimately we are going to need to see a mean reversion or an increase in this stock price for Micron's valuation to start to make sense. And we can get supporting evidence here down if we look at the RSI, which tells us if a stock is overbought or oversold. Micron is towards the lower end of this scale, meaning that it's oversold, so it may not be a bad time to be a buyer of Micron. Gonna wrap the video up here. Thanks so much for watching. Please don't forget to like, comment, and subscribe. And until that next one, peace.